I would now like to introduce Winnie Tam, Senior Manager, Securities and Futures Commission, to begin her presentation.
Hi, good morning or good afternoon, everyone. My name is Winnie Tam from the Securities and Futures Commission in Hong Kong. First of all, I want to thank you, ICMA, for inviting me to participate in today's event. So for the next 10 minutes or so, I'm going to provide you with a quick summary of the recently issued amendments to the Fund Manager Code of Conduct in relation to the management and disclosures of climate-related risk by fund managers. This is just a disclaimer and reminder in regards to this presentation. I think it's quite self-explanatory, so I'm not going to read through it. Maybe just for the participants to briefly themselves. Thank you. So just a brief background. So Hong Kong, being part of China, has a role to fulfill the obligations that China has under the Paris Agreement that was signed back in 2015. And given the large footprint and the international significance of Hong Kong's financial market, the SFC has been monitoring policy developments in relation to green finance since 2018. And in 2019, the SFC engaged an external consultant to conduct a survey of asset managers and asset owners in Hong Kong that focused on their sustainable practices. And the result indicated that only a few asset managers had processes in place to manage the potential financial effects associated with climate-related risk. These fall short of the expectation that asset owner and the international developments. And in light of that, in August 20th this year, the SFC issued amendments to the Fund Manager Code of Conduct and a circular setting out expected standards for fund managers managing collective investment schemes with investment discretions to take climate-related risk into considerations in their investment and risk management processes, and also to make appropriate disclosures to the investors. And at this point, I also want to thank ICMA members for your inputs during our consultation period earlier this year. So the new requirements are aimed to achieve the following objective. First of all, we want to increase the awareness of the impact of carbon emissions and the associated risk. Secondly, we want to ensure that there is proper handling of climate-related risk by our fund managers, which is recognized as a source of financial risk. And thirdly, we also want to promote clear, comparable, and high-quality disclosures so as to provide more useful information for the investors to make informed investment decisions and to combat greenwashing issue. And the final thing is we want to promote consistent standards. And a few key points that I want to highlight in regards to the requirements for the climate-related risk, as indicated in this on the top of this slide. So first of all, the requirement, again, will be focusing on climate-related risk at this initial stage. Of course, we understand that sustainable finance actually involves many aspects besides climate change, for example, biodiversity or water. But nonetheless, comparatively speaking, there are relatively more climate-related data and standards available at the moment. So in addition, climate change is regarded as a source of financial risk by the NGFS, which is the Network for Greening the Financial System. And it falls squarely within the mandate of financial regulator to ensure the financial system is resilient to this risk. And it is therefore appropriate to require fund managers to take climate-related risk into account when managing their investment portfolio. And secondly, in terms of the scope of the requirement, for this initial stage, as I mentioned previously, only fund managers who are managing collective investment schemes with investment discretions will be in scope. That means discretionary account management will be out of scope at this initial stage. And the third thing I want to mention is to foster the development of a more consistent disclosure framework and to minimize the industry's compliance burden. When setting out our requirements, we have made reference to the well-recognized Task Force on Climate-Related Financial Disclosure, the TCFD recommendation. Therefore, our requirements also consist of 4 elements, which include governance, investment management, risk management, and disclosures. And for the disclosure requirement, it will only be applicable to our licensed fund managers who are responsible for the overall operations of the fund, which are referred as ROOF. And the final point I want to mention is that for the expected standards that are set out in our circular, which was also issued back in August 20th this year, we have adopted a 2-tier approach. What this essentially means is if I direct you to the left-hand side of this slide. So first of all, we got a baseline requirement that covers the 4 elements that I just mentioned, which are applicable to all in-scope fund managers. And then on your right-hand side, you can see that we also have the second tier approach, which is the enhanced standards, which are additional requirements covering the areas of risk management and disclosures, and will be applicable to what we call the large fund managers, which are those that with asset under manage of Hong Kong $8 billion or above for any 3 months in the previous reporting year. And I also wish to highlight that the requirements are not intended to single out climate-related risk from other investment risk, for example, market risk or liquidity risk. But rather, what we're trying to do is we want our fund managers to properly consider climate-related risk during the investment and risk management processes, along with the other investment risks that I just mentioned. And if they are also responsible for the overall operations of the fund, then to make adequate disclosures to the investors. We are expecting the fund managers to follow their existing practices for complying with other fund manager code of conduct requirements to maintain records, and also adopt generally the same approach to demonstrate that they have properly identified, measure, manage, and monitor climate-related risks of the funds. Another thing I want to highlight is that the new FMCC climate requirements are applicable to all in-scope fund managers, regardless of whether they are managing a SFC authorized fund or a non-SFC authorized fund. And generally speaking, fund managers should apply the principle of proportionality. What that means is they should assess the nature, the size, the complexity, the risk profile of the firms, and the investment strategy adopted by each fund under the manage in determining how to adhere with the requirements accordingly. And I just want to highlight that the principle of proportionality is actually an existing requirement, which is under paragraph 1.2, subsection D of the Fund Manager Code of Conduct. And the final point I want to highlight is that the requirement for the management of climate-related risk shall not prohibit or restrict a fund manager from complying with applicable laws and discharge its fiduciary duties and other legal obligations in other jurisdictions. And if I may turn to the next slide, please. Thank you. So next, I just want to highlight some key points in regards to each element of the new FMCC climate-related risk requirements for your awareness. So the first element, of course, is governance. As you can see in this slide, the governance will include only baseline requirement, which include requiring the in-scope fund managers to put in place appropriate governance structure, and the board to set the tone from the top and the senior management to supervise and monitor the processes, setting out goals and standards. And the next element is investment management, which also only include baseline requirement. And we would expect the fund managers to identify relevant and material climate-related risks and factor the material risk into their investment management process. And the third element is risk management, which also include tools and metrics. And it include a baseline and also baseline requirement and also an enhanced standards. So first of all, for the baseline requirement, fund managers will have to identify, assess, monitor, and manage relevant and material climate-related risks in their risk management process. We also expect the in-scope fund managers to apply appropriate tools and metrics to assess and quantify climate-related risk. And for the enhanced standard, which again will only be applicable to large fund managers with asset under management of Hong Kong $8 billion or above, at this initial stage, the SFC will require these large fund managers to, first of all, assess the relevance and utility of scenario analysis in evaluating the resilience of investment strategies to climate-related risks under different pathways. And if the assessment's result is deemed to be relevant and useful, then the fund managers are required to develop a plan to implement scenario analysis within a reasonable time frame. And the second thing is we would expect the large fund managers, if they have assessed climate-related risk to be relevant and material, then to take reasonable steps to identify the portfolio carbon footprint of Scope 1 and 2 greenhouse gas emissions associated with the fund's underlying investments, where data is available or can be reasonably estimated, and define the calculation methodology and underlying assumptions. And the final element, of course, is disclosure requirement, which will only be applicable to fund managers who are also responsible for the overall operations of the fund. And it contains baseline requirement and also an enhanced standards. So first, for the baseline requirement, the in-scope fund manager will be required to make climate-related risk disclosure, including the governance structures on climate-related risk oversight, the roles and responsibility of the board and the management, as well as how climate-related risks are taken into considerations in the investment and risk management processes. And for the enhanced standards, we would expect the large fund managers to disclose the engagement policy at the entity level and also disclose the fund's portfolio carbon footprint of Scope 1 and 2 greenhouse gas emissions at the fund level. I would recommend our in-scope fund managers to refer to Appendix 1 of the circular that was issued in August 20th this year, which provide a flow chart that illustrates the applicability of the requirement, which will allow them to have an easy understanding on how to adopt our requirements. And next slide, please. Thank you. So last thing I want to highlight is the implementation timeline. So you can actually just remember two numbers, which is 12 and 15. So first of all, we are providing 12-month transition period for large fund managers to comply the baseline requirement. So that means the effective date will be August 20th, 2022. And we are also providing a 15-month transition period for other in-scope fund managers to comply with the baseline requirement. That means the effective date will be November 20th, 2022. We are also providing a 15-month transition period for large fund managers to comply with the enhanced standards. That is, again, November 20th, 2022, except in relation to the disclosures of portfolio carbon footprint. And for this quantitative disclosure, the large fund managers will need to observe their fund's financial year-end date. And for funds with a financial year-end date after the effective date of the enhanced standards on November 20th, 2022, then the large fund managers are required to disclose to fund investors the portfolio carbon footprints calculated based on the positions as of the financial year-end. The disclosure of this metric should be made through an appropriate channel no later than the usual dates of the fund's audited account or annual reports, which is usually between 3 to 6 months after the financial year-end. And the large fund managers can choose to disclose the portfolio carbon footprint metrics of the fund in a more frequent manner. And they can also supplement with additional metrics as they deem appropriate. And we recognize that some of our licensed fund managers are managing the undertakings for collective investments in transferable security, which is the UCITS funds. And so they need to also comply with the EU Sustainable Finance Disclosure Regulation, the SFDR requirements. Therefore, when we are setting out our disclosure requirement on the portfolio carbon footprint and the implementation timeline, we have also made sure that such timeline is compatible with the EU SFDR Level 2 disclosure requirement when we are finalizing our implementation timeline at that point in time. The final thing that I want to highlight is that we have actually had a webinar which provided training with more details on the climate-related risk requirements back in October this year. And so if our audience actually wishes to know more about the requirement, you may go to the Green and Sustainable Finance page of the SFC official website, which contain the recordings and also the material for the webinar for your information. So, so far what I've been talking about is in relations to the licensed fund managers on how to address climate-related risks. So another thing that people might be interested in is what about whether there's any requirements specifically on SFC authorized funds. On that note, I just want to briefly highlight that in April 2019, the SFC issued a circular on green or ESG fund, which aims to enhance disclosure comparability between similar types of SFC authorized green or ESG fund and their transparency. And then this was actually in June this year, 2021, there's a new circular which replaced the 2019 circular with enhanced requirements for disclosure and annual assessments of ESG funds, especially those with a climate-related risk focus. So just want to highlight that. So that's all with the today's presentation. I'll hand it over to Mustafa. Thank you.
Thank you so much, Winnie. Really appreciate your presentation. Very succinct, very clear. And also want to mention that we appreciate your leadership in promoting transparency in climate risk disclosure. And also you mentioned compatibility with the SFDR. So we actually very much appreciate SFC's efforts to look at other jurisdictions, other regulations, and consider how those might fit in terms of compliance for global firms. So that's really the theme of what we'll be talking about today. We have an excellent, very esteemed panel today, and I'd like to introduce them. First of all, of course, we have Ms. Winnie Tam, Senior Manager, Intermediary Supervision of the Securities and Futures Commission of Hong Kong, and she will remain with us for the remainder of this event. We have Grace Chung of Counsel in the regulatory and digital business practice of Simmons & Simmons, Ms. Christy Wong, Associate Director, ESG Investment Specialist at Amundi, and my colleague Arthur Carabia, Director in the Market Practice and Regulatory Policy team of ICMA. And Arthur basically manages our investor and buy-side practice globally for ICMA. So let's get right into it. But before we start talking about some of the comparisons and some of the bigger issues, I do want to give Arthur an opportunity to give an overview of SFDR. So many of you might be familiar with this. This is the European Union's large and comprehensive regulation law on climate-related disclosure. It's actually very complicated. We've been following it for some time. And so it will be relevant to Asian investors, as we will get into in a little bit. So what I'd like to do is give Arthur the opportunity to give maybe a 4 to 5 minute overview of the high level impact of SFDR, what it's about, where it's going to apply, and then we'll talk about how it might affect Asian investors as well. So the floor is yours, Arthur.
Thank you, Mushtaq. And I think I can't resist the temptation to start comparing the frameworks, because it gives you a bit of an understanding what we're talking about with SFDR. So it's interesting when you describe the current regime in Hong Kong, the new regime, which is very much climate-related focused and leveraging TCFD. In Europe, they decided to have a different approach and to look at all the sustainability aspects and therefore develop their own concept. So that's the first nuance I would bring. That being said, there's also a product and entity disclosure. If you look at entity disclosure, what's also very peculiar in the EU is that they've done both qualitative and quantitative requirements at entity level. Whereas if you look at what Winnie just described, the granular and quantitative aspects are more at product level. And we always argued that it was more relevant to do that product level, but here we are. So let me say a few words about what those entity disclosures are in the context of SFDR. So on a qualitative basis, you're going to have to disclose how you consider sustainability risk for your engagement policy, across your engagement policy, your remuneration policy, your investment decision. And the entity and the scopes are obviously asset manager and other type of asset owner, but for the sake of making this simple, let's say asset manager. And there are also some granular requirements to consider, quantitative, which are the so-called principal adverse impact. So here we're talking about really the ESG footprint of the asset manager, and they're going to have to look at 18 mandatory KPIs that are quite broad. They range from issues such as greenhouse gas emission, biodiversity, water, waste, social and employee matters. And they're going to have to assess those KPIs, looking at all the, really all the assets sitting under the asset management company. That's going to be quite data intensive. There's going to be some data gaps and quite challenging. So a very different approach there. Now maybe moving on to the product disclosure. SFDR require product providers to self-label their product between two categories, essentially. Are you a product with ESG characteristic, which is an Article 8 product, for the people who are familiar with SFDR now, or are you a product seeking an investment, sustainable investment objective, and then you're an Article 9 product? What's interesting is that we've applied so far SFDR at a high level, just the regulation and the implementation measures are not yet being implemented. That will kick in 2023. But what's interesting with the first wave of implementation is that overall, across the two categories, there's 3 trillion of assets under management that have been labeled as either Article 8 or Article 9.
Sorry, Arthur, you mean 3 trillion euro? 3 trillion?
I think it's dollars.
Okay. Anyway, similar.
Yeah, it's based on the Morningstar report, so it's definitely dollars. Essentially, the classification has been quite difficult sometimes, because this dual classification doesn't capture all the nuances certain strategies. So sometimes best-in-class strategies fit better into the Article 8, sometimes they fit better in the Article 9, and also sometimes firms are a bit more risk-averse, so they prefer to downgrade the classification. So it hasn't really brought the level of comparability yet that everybody was expecting. But the implementation measures will definitely be more granular. You will have to give a template to your end client in the context of pre-contractual disclosure. And that will have a series of information that will be interesting to investor. And I think the main one will be the taxonomy alignment. How do you align with this famous EU classification of environmental activities? It will be very tricky at the very beginning because there will be the data set will be incomplete. But eventually, thinking more positively and looking in the long term, those implementation measures should allow to benchmark products in a better way. And the last point I would say on the EU regime, which is quite different than what we see in the rest of the world, is that they're going to ask financial advisors and financial distributors to ask clients, do you have any sustainability preferences? And the way they've done it is that they tie it back to those regulatory categories. So essentially, those products need to have certain features, i.e. being taxonomy aligned or aligned with the sustainable investment definition according to SFDR, or consider principal adverse impact. So there's a real, what strike when you look at the EU is that there's a real will to, in the fight against greenwashing, to channel savings towards those regulated categories. That's also a very distinctive policy development, I would say. I can stop here for now.
Okay, thank you, Arthur. I appreciate that. Actually, let me ask you a couple of follow-up questions, and these might be relevant for Winnie, Christie, and especially Grace as well, as the full-time lawyer in the room right now. So, you mentioned the Article 8, Article 9. I know these are terms of art, so people in Asia may not be as familiar with them. But as I understand, and I could be confusing these, one of the categories under the SFDR is basically ESG focused funds, funds that are intended in marketing as total ESG. One category is a bit of ESG light, so to speak. So funds that have a sustainability objective or sustainability aspects to them, but are not marketed as focused 100% ESG funds. So confirm that is correct, and maybe you can give a bit of nuance about around those categories. But one thing I did want to emphasize or ask you to correct me on is that, in my understanding, SFDR basically applies to all European funds or all funds marketed in Europe, and there are requirements not just for ESG focused funds or sustainability marketed funds, but really there are climate risk requirements, climate risk disclosure requirements for basically any type of fund that has a European nexus or European marketing.
Yeah, who's going for the should I go for it? Okay.
Why don't you go first, Arthur?
Well, there are definitely some risk management considerations. So firm will have to disclose how they consider, as I said, sustainability risk, and sustainability risk is defined as how sustainability aspects will impact investment returns. So it's very risk management focused and return focused. And you need to disclose how you consider this in your remuneration policies, and your engagement policies, and then how and your investment decision making process. So it's quite broad ranging, but very difficult to capture and really define this in a granular way, because we're really in the very beginning, and we know when we do climate stress testing at banking level, or when we consider those model, it's very subject to, first of all, do you have the data? Do you have scope 1, scope 2, scope 3? And we know that scope 3 is always a challenge. It's also subject to methodological choices. The consideration of sustainability risk and the risk management aspect of SFDR is quite broad at the moment and not too prescriptive, I would say. Whereas what I've described as the principal adverse impact, which is the other layer, is a lot more granular, and it's really about ESG footprint. About the categories, as I said, is sometimes a mystery, but I think it's fair to say that the first category bucket is ESG characteristics, so ESG product, and then the other one, if we want to put it in simple word as well, would be a product that make a sustainable investment objective. So that's really subject to interpretation, right? It's impact product should definitely sit in there, that's for sure. And then there's categories where it's less obvious. For instance, if you're a best-in-class strategy and you're seeking to have a certain climate score, when you select companies, could you consider that as a sustainable investment objective? And that's really subject to interpretation and also negotiation sometimes with your local regulator. Do they accept the concept of you marketing your product as such? And it's quite nuanced, and I don't have a straightforward answer yet. And everybody is trying to still make progress and learn collectively how to handle it.
Sure, but let me just try to step back a big step and just try to oversimplify this area, this discussion a bit for those in the audience that may not be experts in sustainability or sustainability disclosure. It seems to me that what we're seeing emerging in these regulations are really three types of disclosure from an asset manager's point of view. One is climate risk. So this is climate sustainability in the context of investment risk. How can climate change affect my returns? How can climate change affect the valuations in my portfolio? The second would be the impact of the portfolio. So what is the carbon footprint of my portfolio? How are the investments that I'm funding actually affecting climate change, either positively or negatively? And the third would be more product disclosure, which is your kind of traditional retail disclosure to ensure that funds that are marketed correctly, accurately, and not in a way that's somehow misleading. So in particular, to prevent so-called greenwashing. Is that a reasonable way to characterize it?
Yeah, you did it perfectly right. So those two concepts, and then at product level, those two concepts will be injected in the product disclosure. Exactly right. And I think that's been done when we listen to Winnie. Clearly, this appear quite in the SFC framework, but also in the EU. And we're asking for consistency, and in that sense, the approaches are quite consistent.
Well, certainly, we see SFC covering all those bases. Great. Okay, let me move on to Grace now. And Grace, you've been following. Fortunately, for us, we have you on here, and you've been following both SFDR as well as the SFC's rulemaking. You're based in Hong Kong, and you're covering Asia. So, can you tell us a little bit about from your client's perspective, from an Asian investor's perspective? They have to consider the SFC's new code of conduct, or the existing code of conduct as well. They have to consider the potential extraterritorial effects of SFDR. Tell us a little bit first, to maybe get a little bit more detail about how SFDR might affect Asian investors. And then if you could maybe take a bit of a broader view, looking at what are some of the other regimes, some of the other regulations in the region and even globally that an Asian investor might have to consider when formulating their disclosure.
Sure, thanks very much, Mushtaq. So on my front, I think what I see on my end is based on some of the work we have been doing with some of the large and smaller asset managers in being aligned and compliant with the SFC new guidelines, as well as the environmental risk management guidelines in Singapore, which came into effect earlier, and and we see the regulator having very detailed, sometimes 2 to 3 hour meetings with each specific asset management company, going to detail on their ESG practices and guidelines. So first of all, I'll start with your first topic on the SFDR, because I think that has been a topic which, similar from the wave we saw from MiFID, we also saw a lot of interest in this topic in terms of how it affects non-EU managers, and whether this goes into more detail on just a product disclosure level, or whether it affects website disclosures and overall risk management policy frameworks. And if you're a manager in Hong Kong or Singapore or somewhere else, how this would affect your practices. So I think what is useful to refer to is on 26 July 2021, the European Commission published its long-awaited replies to the questions raised to the European supervisory authorities. And I note this because previously, I believe the industry had a lot of speculation on the on the impact on the extraterritorial impact, and there were some differences in views, that I could encounter in terms of the application to non-EU managers. But the summary of the Commission's answer in that context on the application is that SFDR does apply to non-EU AIFMs, and they're included in the definition of AIFM under the AIFMD. So what this means is that the trigger point for the application of the SFDR for non-EU AIFM is of a given.
Sorry, Grace. Just want to clarify. AIFM, that's Alternative Investment Fund Manager.
Oh
Is
yes.
that right?
So sorry. I sometimes,
okay.
Use these terms.
Most might be familiar, but you never know. Okay, thanks.
Yes, comes from my MES background, where MES similarly uses all kinds of terms. So yes, so based on that, if a non-EU AIFM uses certain points of recognition. So for example, the national private placement regime in the EU, then they have to ensure compliance with the SFDR, including the financial product related provisions. So what we felt that this was in line with the general approach in the market, which was taken ahead of 10 March 2021, which was the previous deadline, and to which was the assumption in the industry that the SFDR would apply to non-EU AIFMs which market alternative funds in the EU. And it is helpful and in line the standard interpretation on how this was marketed. So I think basically what it means is that you would have to consider, if you're marketing funds in the EU, on the impact on how it applies to you if you're marketing the fund. So the prevailing industry view, which is aligned with our view, has been that the SFDR applies to the manager in respect of the relative funds being marketed into the EU under specific regimes, and not all funds that are being marketed. So I think that's one point to note, that you're considering specific types of funds which are being marketed. And I think one of the interesting points on the Q&A is that it states that the AIFM must ensure compliance with SFDR, including the financial product related provisions. So I think what we have deemed from that is that the manager is directly in scope, but it could mean that as a regulatory matter, all other regulations in terms of the need to publish a sustainability risk policy and to make a comply or explain decision on the PII regime, and mandatory compliance on the PII aspects may apply to a non-EU manager. So I think these are some of the difficulties.
Sorry if I may interrupt. What is the PIA?
Oh, principal adverse impact. Yes, I must.
Principal adverse. Okay, great.
Yes.
That's basically that's the impact of the fund, basically like the carbon footprint of the fund.
Yes, the
so
carbon footprint.
Roughly speaking. Okay, thanks.
Yes, I believe it was mentioned earlier in the summary as well for the SFDR, but I think that has been one of the considerations. Although I do note from a review of the Hong Kong and Singapore regulations that a lot of the regulations are focused a lot on the risk management aspect, and the product risk disclosure has previously been more focused on the public listed funds. And even Singapore is devising a new regime which is starting 2022, focusing on fund labeling type requirements and disclosure requirements, similar to what Winnie was alluding to earlier, which has happened in Hong Kong. Singapore is also going to publish very detailed requirements in this respect. So on a brief note, I think one question which always comes up is that if you're already compliant with the EU SFDR type requirements, how does this affect a Hong Kong manager, or how does it affect a Singapore manager? And I'll provide some context because I head up the ESG working group in ICMA, which is the Alternative Investment Management Association. And in that context, we have been heavily involved in the last 2 years in gathering industry feedback and providing feedback to both the MES and the SFC in context of the climate risk guidelines. And so what I do note is that I believe quite a lot of the asset managers, unless they have had a huge presence in Europe, they were actually quite new to this whole space and thinking about how this affects them, and basically what kind of uplift or new requirements they had to implement. And despite a lot of the language being different and requirements being different, I did come to a point where it was interesting to note that both regulators did indicate quite clearly that if you do leverage your overseas, your group policies and procedures, that could account for helping to meet the baseline standards or enhanced standards if you already follow the SFDR standards. I did note that quite a lot of asset managers were thinking of implementing regional ESG committees in line with the increasing expectations on senior governance. So that has been one of the aspects which has been quite important in development in building up governance frameworks and oversight frameworks. And for the investment risk aspects, quite a lot of asset managers did have EU or US type formulations on how they calculate carbon footprint, how they calculate whether it's material or relevant. But how does this change or evolve to Asia, where they might be having very different types of strategies, different types of fund makeup, and sometimes their teams in Asia are extremely small in comparison. So I think there are very practical considerations in that regard, which we have been involved in discussing. And even though I think the Singapore Environmental Risk Management Guidelines came out first and the Hong Kong one came out much later, and there was a lot of debate and dialogue with the SFC on that, I think what it comes to is that actually one of the most important challenges for the industry has been materiality, because it's quite difficult to say nowadays that ESG is irrelevant to most fund strategies. So usually quite a lot of the debate then jumps to the question of materiality. And there is some guidance from overall frameworks and benchmarks on how you define materiality, but it's often a struggle for a lot of the local asset managers to decide how they want to calculate the different risk scorings based on their strategies, whether to have a local mandate versus a global ESG mandate, and a lot of the practical issues involved with that. So I'll pause there because it's a lot to take in, but I'll pass on back to you, Mr.
It is a lot. Well, thank you very much. No, that's a super helpful, I would say, intermediate level overview of how the SFC and the SFDR regulations may affect asset managers.
If I may just jump in,
Yes,
because
please.
Grace mentioned a point about the relevant and also the materiality assessment. So actually on that note, maybe if I may just to
Please
jump in and add some color on that aspect. So of course, I think we all recognize that there's no one size fits all approach in this regards. And so if in regards to this topic, I would first suggest our audience to refer, if you're referring to the SFC requirements on the climate-related risk management disclosures for fund managers, then I would suggest our audience to refer to answer to question 3 of the FAQ in relation to the climate-related risk requirements, which exactly is addressing this concern. And I just want to highlight one point is our view is that given the broad spectrums of climate-related risk and the wide range of financial assets and investment strategies in the market, so that's why we consider it's actually more appropriate to take a pragmatic approach and allow the fund managers to have the flexibility in determining whether climate-related risks are relevant material based on their investment strategies. But having said that, we did try to provide as many guidelines or informations to the fund managers as possible. For example, we have included a industry practice document under Appendix 2 of the circular that was issued back in August 20th this year, which provide examples on how relevant and material climate-related risk should be assessed. And on top of that, as I mentioned before, we have a webinar in October this year. We actually have a dedicated sections in regards to relevancy and materiality assessments, which actually provides some more examples or explanations on how that should be addressed. So again, all the audience can actually refer to our SFC website for the recordings of the webinar. So we just want to highlight that. Thanks.
Okay, great. Thank you so much. Actually, that's super helpful because I have been involved in some of our discussions, and Arthur has, of course, too, on materiality in sustainability. This is a fraught topic. It does tend to make lawyers somewhat nervous sometimes, and I think that one thing that is actually very, very helpful is having regulatory guidance on this, because then you just have more certainty and compliance. But of course, this is it's a moving target. I mean, it's a very quickly evolving field, and so it's not easy always to strike that balance. And of course, to strike the balance within the context of your industry, within your fund, within your types of investments, within your jurisdiction. So we could probably talk about materiality for hours and hours, but I think it's very helpful that the SFC is providing additional guidance there. Now, I'd like to go even more concrete. We're very honored to have Amundi, which is obviously one of the world's leading asset managers and one of the leaders in sustainable investment as well on our panel. And Christy, I think it would be very helpful if you could talk about sustainability disclosure from your perspective on a very pragmatic level. So when Amundi is putting together its disclosure, I mean, obviously you and your colleagues are in charge of deciding what gets disclosed, how it gets disclosed, where it gets disclosed, when it gets disclosed. You have to consider all the various regulations around the world. You have to consider your internal policies. You have to consider the needs of your asset owners. You have to consider the needs of your overall strategy, perhaps public perception as well. So there are many different factors involved, as well as the legal aspects of materiality and your own views on climate. So how do you bring all of that together? Walk us through how you consider, how you formulate your overall disclosure in Asia, and how, in particular, how you consider the various regulations, including the SFC's code, SFDR, and any other regimes in the region and globally. Sorry, I know it's a lot to ask, but let's see what you can do there. Thanks.
Thank you. So I think this is a big question, and is absolutely right that we are seeing different ESG regulations and requirements in different markets, and the number of regulations keep growing and growing. So if I can just take the biggest regulation, the SFDR, as an example, and also the local regulation that we need to meet here, the Hong Kong climate risk disclosure requirements. Based on our experience, that for our funds that are already categorized as Article 8 or 9 of SFDR, and when we take all these funds and register as ESG funds with SFC here, we do not encounter any major difficulties. And it's also based on the SFC ESG funds circular released earlier this year. It also mentions that for funds that are already have met the requirements for Article 8 or Article 9, then they will be deemed to have generally complied in substance with the disclosure requirements. So I think for Amundi, I'm really lucky in the sense that over 60% of our overall European mutual funds, AUM, are already classified under Article 8 or 9. And in terms of the size of AUM that we have under Article 8 or 9, we're actually the largest in the world. So I think having that as a foundation, and for us to comply with the Hong Kong SFC requirements is actually a very smooth transition for us. There are some like minor local enhancements that we need to meet. For example, for one of our funds here that have adopted an exclusion criteria, we have already put that into the prospectus, like in terms of like the qualitative exclusion threshold. But when we talk to SFC, they may ask us for more information in terms of like the quantitative exclusion threshold, which we already have that information in place, but we just didn't put that into the prospectus. So I think for us, it's only about submitting minor information to further elaborate our product information. We don't need to invent or develop anything new at all. So I think it's a smooth transition for us.
Okay, thank you, Christy. Any other regimes that you have to think about? I mean, we've Grace mentioned Singapore risk disclosure as well. Do you see any other regulations in the region that are causing any additional disclosure, or actually any emerging regulations in the region that you think will be coming up in the next maybe 6-12 months as well that you're looking at closely?
Yeah, sure. I'll have a go, and then perhaps Grace and Winnie can also
Sure,
add their
of course.
input as well. So I know that other than the Singapore, the environmental risk disclosure requirement, which is similar to the Hong Kong one, but in the sense that the scope is different because it covers the environmental risk instead of just climate risk. And for the Hong Kong one is more prescriptive in terms of the metrics that we need to report. And other than Singapore and the Hong Kong one, my understanding is that in India, the Securities and Exchange Board of India also came out with the consultation paper for introducing disclosure for ESG mutual funds, and it came out in October, so it's relatively new. So the proposed measure are aimed at ensuring that ESG-focused mutual fund remain true to the label. And according to the consultation paper, it proposes that the ESG label fund to invest at least 80% of total assets in ESG-themed securities. And they need to disclose measures taken to mitigate greenwashing risks and reliance on third-party scores.
That's right. And we've just responded to that as well. I think it's more focused on, probably more, our reading of it is that it's more focused on equity funds, not as applicable to debt funds. But we have actually in our response proposed that they amend or adapt the guidelines so that it can be applicable easily across all asset classes. But as you mentioned, Christy, you're right. This proposed regulation in India by the SEBI is mainly targeted at ensuring that the disclosure of sustainability funds is accurate and representative of the ESG nature. Let me give Grace a chance to respond to that as well, just in terms of the other sustainability disclosure regimes that you're seeing in the region, how they compare to Hong Kong's and the EU's, as well as potentially other fund disclosure regulations of any type that you see in the near to medium term future.
Sure, Mushtaq. So I think one thing which is useful to note is that about 2-3 years ago, when we did a detailed survey of different jurisdictions in Asia, what we had noted was that quite a lot of the ESG guidelines and requirements were all focused on helping to build up mandatory guidelines for listed companies. And there were fewer which were specifically focused on the asset management industry, or if there were such guidelines, they were more principles in nature to be relied on. But I think what we're expecting is that in time, there will be more similar guidelines being introduced in the industry, which are more aligned with SFDR and some of the developments in the region. So I think one of the things which we note, for example, that in China, this is a fast moving pace. And previously, there had been green investment guidelines issued by the authorities over there. I write AMAC, but I think it stands for something, Association of China in relation to asset management, but I might be wrong. The CSRC, the China Securities Regulatory Commission, also revised the guidelines of listed companies quite recently. And a lot of the requirements in China are really focused on different areas of green finance, bonds, and also in line with that taxonomy development. In Thailand, I believe that they are also working to work on the investment code by the SSC, which was previously put into place. So even though quite a lot of the guidelines have been focused on listed companies, we also expect more to expand to asset management in time. And in South Korea, for instance, there are new regulations being developed for asset managers, and over there is the National Pension Service of Korea's guideline on shareholder activism. So what I need to note is that ESG is something which is affecting different sectors, and different regulators in this space would then influence some of the requirements which are going out in this space. So very briefly, with that in mind, I'll also note that that is why when it comes to data development and platforms and roadmaps for climate-related financial disclosures, I think in line with that, it is quite important to really keep up with the landscape and analyze it quite closely. So an example that I often get in terms of questions is, there seem to be so many taxonomies. Will each jurisdiction in Asia be coming up with their own taxonomy, which has been quite a concern. I would say that at least in Hong Kong and Singapore, there have been various developments where both jurisdictions are contributing to the development of globally interoperable taxonomies to improve sustainability disclosure. And so even I sit in the sustainability working group in ICMA. So even when we were working on or considering the taxonomy discussion, I think the aim is to ensure interoperability than to develop and draft a whole new one for each jurisdiction. And that is where I predict trends going forward. And there have been some interoperable trends as well. For example, in Singapore, you have the Monetary Authority of Singapore's Green Print initiative, whereby MAS is partnering with the industry to develop interoperable platforms that will provide the data needed for the green finance ecosystem. So lastly, I will just briefly mention the IOSCO guidelines for asset managers with regard to ESG, which we contributed to together with ICMA as well. And that had various guidelines for the industry for asset managers in particular. But one of the aims was also greater consistency. And one of the observations that we provided in feedback was that perhaps product level disclosure may be easier to manage for a lot of asset managers rather than coming out with a lot of different principles from the investment risk management level, which are sometimes a bit hard if different jurisdictions come up with different requirements and expectations in that regard.
Okay, well, the last point you made, I think, is one that Arthur has been making for some time now about product disclosure versus entity level. So we appreciate that. You've touched upon two of the hot topics in overall sustainable finance discussions lately, certainly from my perspective. One is taxonomies, and the other is data and fintech. So I do want to talk about taxonomies. I'm going to park that for now. But let me ask you about data. And actually, I'd like to hear yours and Christie's, and maybe even Winnie's views on this. We have a question from the audience. By the way, for those of you in the audience, we very much welcome your questions. So please send them through the SpotMe platform. We'll receive them here and try to ask the panelists in the time we have remaining. One question we've received from the audience is the perennial one, the 2021 big question. Is there sufficient and reliable sustainable bond data out there that the buy side can rely on? Now, Christie's answer before was fairly optimistic, but we are hearing from other quarters that there's a big problem with data. It's impossible. There's not enough data. We can't disclose. So I'd like to hear, first of all, from Christie, perhaps. Are there any problems with data in terms of compliance with the regulations, or is the data problem addressing a different kind of problem? And then perhaps Grace can address this from an industry perspective as well.
Yeah, sure. So talking about data, I think this is common, a common problem that we encounter. So I think for now, most of the asset managers actually rely on third-party data providers to provide the data. And what we see is that the data, it can be quite different from provider to provider. So taking carbon footprint as an example. Not every country has a mandatory requirement for companies to disclose carbon footprint data. So in that case, so some of the data providers actually made estimation based on their own methodology to estimate the carbon footprint data. So I think this actually raises the question is, okay, so I have got the data, carbon footprint data from external service provider, but how can I guarantee the accuracy of the data that I get? So I think this is still an ongoing discussion among asset managers, and I think talking about equities is actually easier. And if we talk about bond, carbon footprints is actually even harder because there is no standardized way to measure carbon footprint of a bond portfolio. So I think there still need to be discussions on how we can advance our data collection and reporting methodology.
And
great. Yeah, Arthur, go ahead, please.
As an additional comment, and I completely concur. That's what we hear from our members, and also that in a space that is supposed to be potentially impactful or contribute to climate change, asset-backed security. the paucity and the level of data is even worse there. And we know it should be available. For instance, you would think that for RMBS you would have a good level of information regarding the energy performance of buildings, and we do have like in EU some certificates, but actually there's no trade repository, there's no like registry we can collect certificates, and sometimes they're not available. So the most basic information is still needed, and even for auto loans, asset-backed securities, sometimes you don't have the information. So I think I will echo what Christy said. There's a real need to really take it to the next level, so that the disclosure requirement for asset manager are actually helpful for investors and not rely too much on estimates. Yeah, that would be my additional comment.
Okay, but my question, and this, I think this is for Grace, is first of all, is it just the fact that some of the data that would be required for these disclosures is simply not available? Or is it more the case that it's available, but maybe not in the best format, or in inconsistent formats, or in a way that's not entirely verifiable? Is it more about that rather than a black and white question? And then the kind of second part of my question is, do these difficulties, are they more practical and kind of technical difficulties, or does the lack or insufficiency of data actually result in regulatory and compliance risk?
Sure. Yes. Yes. I entirely agree with Arthur and Christy on their observations. So what I would note is that it really varies according to area. So Christy is very right there when she says that for equity, there's usually quite a large percentage for which data can be found from the service providers. But in emerging countries, this is often more of a challenge. I do recall that when we were preparing for the response to the SFC guidelines, for instance, that one of the asset managers noted that she had done a very detailed review of 7 managers, and out of the best one, it only fulfilled about 30 to 40% of the data which they needed. So they have to create some sort of internal observations or proprietary framework. So when it comes to bonds and credit, I do agree there that what I have seen are mostly proprietary scoring systems internally, and there are different ways to develop this. I mean, in Hong Kong and Singapore, there have been the flexibility provided by the regulators to develop this, and what we have seen in this space is, for example, the SASB standards being used to really measure materiality, and the assessments are more on sort of industry leading basis in calculating scores in the credit industry, where it's not hard on or objective point of view, but instead they draw in different types of data and make assessments upon whether it is industry leading kind of issuer, or and also include a forward-looking trend analysis looking at the trajectory of each issuer's ESG outlook, which can be classified as, for example, improving, stable, or deteriorating. So there are different elements which are usually included in the credit type analysis, which I have seen. And also, I think one thing to note is that a lot of these scoring systems, when developed on a proprietary level, these may also change in time because of their relevance or impact. So when it comes to a bond or credit strategy, this might, the type of scoring or the impact of ESG factors may also require a regular iterative approach, where such scoring is also evaluated as part of the global and regional working group strategy of different firms. So I think this does apply differently, but I do think that for certain kinds of areas like credit, it does require a more in-depth approach. So lastly, I'll just briefly once again talk a little bit more about Project Greenprint, because I think MAS in Singapore is trying to resolve this issue by piloting 4 common utility platforms to address the sustainability data needs. So I won't explain each of them, but I think it's helpful to know basically that there will be a data orchestrator which will aggregate sustainability data from multiple sources, an ESG registry, and a Greenprint marketplace, where essentially green technology providers will be able to connect with different investors, financial institutions, and corporates. And maybe in time, this will be a kind of model being pursued in the region in terms of creating and aggregating sustainability data.
Actually, sorry to put you on the spot there, but I'm actually very interested in this. And I'm also aware that in Hong Kong, the HKMA and BIS have a, I'm not going to say similar, but in the same same objective type of project called Project Genesis, which is also intended to make sustainability data more available and more efficiently delivered through DLT and through technology. So that's great. I mean, it's fantastic for me as in Asia to see both Singapore and Hong Kong being leaders in this space. But I'm wondering, again, sorry to put you on the spot here, but can you maybe give us a very concrete use case for Project Greenprint? So what is the kind of data that will come into it? How is that going to be used in real life by an asset manager, by an investor? Walk us through the whole process of how that data kind of comes from a very raw format to being applicable and reported in the end, even in sustainable reporting to a regulator.
Okay, so I'll try my best because a lot of it is still in the building form and based on what MAS has released. But the idea is that this all starts with the basis of the common ESG disclosure platform to manage and access ESG performance data. And the network of different data platforms is then aggregated by the data orchestrator. So what this means is that the data orchestrator will draw a common network of data from ESG data providers, from common utilities, from open data like satellite data or nature data. And this will cover all sectors, rubber, aquaculture, palm oil, different sectors. And all that data will be aggregated by the data orchestrator, which will then hopefully make this into more consistent and accessible ESG registries, which, as you said, is a blockchain-based network in Singapore of registries to record and maintain the provenance of ESG certifications and verified data. And from this, all this draws up to form a greenprint marketplace. It sounds like a beautiful idea. Greenprint marketplace where the green tech providers will then discuss and use this data, maybe have test projects to work together to improve the quality of certain types of data, and you will feed back to the ESG registries. So I think the idea is that you're building almost a network and infrastructure that's iterative and regular rather than a stop point in time. Yeah,
sure.
So
I'm trying my best to separate the rah, the hype from the actual kind of how is this going to help my job, right? How is this going to help me comply? But I think from what I can see theoretically, it does seem to be a very interesting pilot project with the intention and the effect perhaps of building standard types of reporting, improving the consistency and reliability of data across industries, rather than kind of corporate sending PDFs to individual investors and it all being kind of decentralized. You're having a kind of a more organic marketplace to help improve that data across the market. I kind of see that where it's coming. Now, I hope it works. It sounds very interesting, but I'm certainly not expert enough to be able to predict that. Okay, does anyone, sorry, any of the other panelists want to comment on this theme? Otherwise, I'll move on to more questions. No? Okay. Well, one thing you're talking about, Grace, in terms of standardization, right? That's one goal, I think, of some of this technology. And I do want to talk a little bit among this panel, especially about international standards, emerging international guidelines in sustainability reporting. Of course, from ICMA's perspective, it's no secret, and from our members' perspective, we are very much in favor of as much consistency and harmonization and efficiency in these regulations as possible. Of course, there's no one size fits all. We totally understand that, and we very much understand that different regimes have to adapt to local law and local situations. But at the same time, we do certainly encourage coordination, if nothing else, and consistency among these guidelines. I know that there's quite a lot of work being done at the international level among securities regulators, among central banks, among even trade associations. And perhaps, Winnie, I'd like to ask you, if you can, to speak from SFC's perspective on some of the international standards, some of the maybe some of the more international type of standards coming out that are related to sustainability regulation, especially in terms of say, accounting and disclosure and TCFD, for example. What are you seeing from the regulator's point of view, and especially from your key role within IOSCO, which is basically the global club of securities regulators?
I think maybe in a more general sense, I would highlight the fact that I think our CEO, Ashley, he also mentioned this point in another event, actually just this morning, is that because of the COP26, actually IFR's foundation announced the formations of the International Sustainability Standard Boards. So they're going to provide a sort of a single corporate disclosure standards, which is targeted to issued out next year. So I think that is one of the upcoming initiative that it's good to look forward to, because I think along the way a lot of the panelists also mentioned about the fragmentation and so forth, and the limitations on the data. And the fact that we are having this standardized approach internationally on how corporates should provide the disclosures going forward, that is something that would help on these kind of issues. And in Hong Kong, for Hong Kong side, I understand that through the IOSCO technical expert groups, we are sort of participate involved in this upcoming standards. So that's one of the things. Another thing, maybe I just want to briefly highlight, it's about the taxonomy that Grace also just mentioned. Sorry, I just want to get my notes out just in case. Okay, so I think maybe some of you might already know that there's also a common ground taxonomy that's issued out last month in November as well. So that is taking into considerations of the EU taxonomy and also the China taxonomy. So for the Hong Kong side, what we are aiming to do is we are continue with the work and the aim to make use of the common ground taxonomy going forward. So that would be our approach as well. So that's the two things that I do want to highlight. Yep.
Okay, well, great. Well, that's actually good news for I think ICMA and for our members. We're very actively looking at the various taxonomies coming through. The common ground taxonomy announced at COP is, in my personal view, I don't wish to speak for everybody, but in my personal view, a really, really positive development, and I think changes the conversation a little bit, because in my personal experience over the last few years, it's very easy for people to highlight the differences in all of the different international taxonomies, or sorry, the different taxonomies coming out internationally. But I think the common ground taxonomy, it's worth a read actually. It really highlights how much commonality there is, and where all of us basically agree on what is green and what is not so green. I think it's the vast majority, quite frankly, and I think it really gives enough or quite a lot of guidance for us to have very consistent approaches towards this. But I'd like to open it up to other panelists as well, perhaps Arthur as well, because you're tracking a lot of these developments internationally. How do you see the taxonomies fitting into sustainability disclosure? And do you see any potential risks in terms of other regimes, other clashes with different taxonomies? Or are you fairly optimistic about the interaction between the sustainability disclosure requirements from a regulatory level and the various taxonomies emerging globally?
Yeah, I mean, what I know of the EU taxonomy is that, and I'm not the expert at ICMA, it's more sustainable finance team looking really deeply into this. But what I've looked for it for the taxonomy product disclosure requirement that we discussed, and what we realized is that it's difficult to implement it. We have a nice gold standard that's conceptually extremely nice, shiny object, but it's sometimes hard to deploy it when you go invest outside the European Union. So that would be the main challenge. And it really ties the difficulty around to do no significant harm, which is this concept that essentially you have to look at the impact you may have on over environmental objective or social objectives. And you also have to have minimum social safeguards. And that's when it becomes tricky to apply abroad. And I think we're still digesting this and trying to make the most out of it. And there's a sustainable finance platform in the EU that's looking after this, and I will make recommendations as to how to use it abroad. And hopefully we can find some pragmatic solution while respecting the concept and the concept of the taxonomy. So yeah, that, you know, I don't think the EU wants to give up on this. So the common ground taxonomy is certainly helpful, but the EU vision will remain, and we need to make the most out of it. So that would be my first comment. And then on the ISSB and the potential issuer sustainability standard, that would be great. I think everybody would like to see that happening, but it needs to happen fast, because you know, everybody is moving on non-disclosure requirement. If you wait too long, everybody has been grappling with the concepts and everything, and if it introduced too late, then it's helpful, but not as, you know, it's really needed today. So hopefully they can make maximum progress and deliver a first batch of standards quite soon. But it's definitely a positive development as well. And then ultimately, you know, we can build on this and have more and more harmonized and convergence internationally between the disclosure regime once we have the issuer standard at global level. That
Okay.
would be my comments. Yeah.
Sure, thanks, Arthur. Actually, I just want to follow up with a bit of a technical question. Maybe this is for Christy and Grace mostly. We do hear quite a lot about the do no significant harm aspect to the EU taxonomy, I'm going to avoid all of the questions about what the taxonomy is used for and all those theoretical questions, but just focusing on do no significant harm. There have been some concerns from Asia Pacific about this, not because it's a problem having a do no significant harm aspect to a taxonomy, but just because some of the standards are much different, right? The kinds of social standards and labor standards and so forth in the EU might just not be applicable or relevant to some of the jurisdictions in Asia. Now, have you seen this, Christy and Grace, in the context of sustainability fund disclosure or climate risk disclosure? Has this been a material issue?
So I think from our perspective, I think this issue is actually very much the same as how the Asia Pacific ESG landscape is different to the European ESG landscape. So taking China, for example, there are also discussions around how the ESG landscape is different. For example, the social aspects and the governance aspects are different. So from our perspective is that as an international asset manager, it is our responsibility to bring together the international best practices to different regions so we can enhance the ESG standard. So that would be my answer.
Thank you, very diplomatic. Grace, do you have any response to this?
Yes, I do think that when reviewing the Hong Kong and Singapore guidelines, and Winnie, please feel free, correct me if I'm wrong, but a lot of the focus has been on investment risk management and trying to curb greenwashing by clearer disclosures, and really it's quite internal focused. And the do no significant harm principle also draws in, as Christy has noted, some governance elements, some social elements, and the impact of your investments on society, on the wider impact. I think, at least from what I see from Hong Kong and Singapore, it has not moved to that extent of regulatory requirements and expectations, even though governance, of course, has been a very key and important element. And I do believe that, when CFA, the CFA Institute was coming out with data in Hong Kong, they found that actually the governance scores and, guidelines for, and what issuers were adhering to in Hong Kong was actually very high, even before, the listed companies' mandatory requirements started to come into effect. So I think more companies are recognizing their ESG obligations, as Christy has noted for Mandi, and recognizing the impact of their investments on the rest of the industry at large. But so far, in terms of a strict regulatory requirement and trying to have that balance of what do no significant harm does come up with, I haven't seen it implemented to that extent as a mandatory requirement as yet. Yeah.
Okay, well, thank you very much. I think that both your answers are quite reassuring. There are sometimes theoretical difficulties that they don't seem to have translated into very hard practical or compliance difficulties yet. Well, I'm very sorry we are out of time. This has been a fascinating discussion. I've certainly learned a lot. We could probably spend a couple more hours on some of these topics, but I really appreciate everyone's time. Thank you for those of you in the audience for sending your questions. Sorry we couldn't get to all of them, but if you do have further questions that you'd like to address to ICMA, please do feel free to put that in the feedback form, or you can contact us directly at apac@icmagroup.org. With that, please stay safe, and I wish you a good week ahead. I'll hand it back to our events coordinator now, Leanne. Thank you.